2026 is just around the corner. And I want you to honestly ask yourself one question before you watch this video. What did you actually achieve in trading during 2025? Not what you planned, not what you hoped, but what did you actually achieve? Because if you're still feeling lost, jumping from strategy to strategy, failing prop from challenges, are down or even break even on the year, then this video might be the most important video you watch before 2026 starts. In this video, I'm going to show you how 2026 can be the year that you finally become profitable, the year that you finally stop passing prop from challenges and start getting real payouts. I'm not going to be giving you no motivation fluff today, no get rich quick scheme today, but I'm going to give you a step-by-step process that actually works. And if you stay until the end of the video, I'm going to show you exactly how traders turn one payout into multiple payouts again and again and again. Every year, traders say the exact same thing. This is my year. I'm locked in. I've got a new strategy, and nothing changes. Not because they're stupid, not because trading doesn't work, but because they don't have a system. 2026 won't be any different unless you change the structure of how you trade. So today, I'm going to be breaking down that structure into three different parts. The three parts that we're going to be talking about today is the strategy, the prop firm route, and the payout cycle. These three main components are going to get you to that profitability stage. And this is what I've seen with my own students work again and again and again. So I'm going to be breaking it all down for you today. So to start off, we're going to go through the strategy checklist. And the one thing that I can tell you is that if your strategy isn't already simple, repeatable, time specific, data backed, and pair specific, you're already at a disadvantage. But you don't have to worry about that in this video. The reason why that is because I'm going to be giving you my own strategy that has made me thousands and thousands in the market. And you can even go watch those live breakdowns of me making thousands in the market using this strategy. And the strategy that I'm talking about is my Euro USD and GBP USD inducement strategy. So let's break this down so you can understand it even better. The first thing I want you to understand is pairs and timing. You might be thinking, what does that mean? I mean that you should be only sticking to 1 to 2 pairs maximum. You shouldn't be trading 30 different type of assets in the market because that will confuse you a lot. You'll lose your focus and you won't actually be able to become an expert at trading a certain pair. And by timing, I mean using the certain key time windows in the market that will give us the most volume and give us the best entries possible. The two pairs that we're going to be using is Euro USD and GBP USD. And the time windows that we're going to be using is 8 a.m. till 9 a.m. London session. And for Americans, that would be 4 a.m. to 5 a.m. And for the New York session, we're going to be trading from 2 p.m. till 3 p.m. And for Americans, it's going to be 9 a.m. till 10 a.m. in the morning. If you guys need to keep these times, make sure you screenshot this right now and put this in your notes because this is very important. Now that we know what pairs we're going to be trading and what times we're going to be looking for trades, let's jump into the actual strategy and how to use it. The first thing I'm going to be breaking down is bias and how to figure out where you are in the market and where the market wants to go to next. So as you know, we have three ways that the market moves. It's either bullish, consolidating, or going bearish. Bullish means it's going up, consolidating means it's going sideways, and going down means it's bearish. And there's only two moves that the market likes to do: main pushes and complex pullbacks. These are the first two things I want you to note down because they're very important. So let's jump right into this. So the main push is the push that goes with the trend and normally has a lot of volatility. The complex pullback is the much slower move against the trend, coming back to those zones before it starts continuing with the trend and creating a new main push. So normally you have a main push, you have a complex pullback to come into a zone before it starts creating that new main push. So these are the two ways the market likes to move. So let me explain how it actually looks like. So right now, this would be your first main push because we can identify that we're heading up higher. We're breaking structure to the upside right here, and we keep pushing to the upside. We keep breaking structure, pushing to the upside, breaking structure again, so we can clearly see we're in a bullish market. So that means if the moves that are with the trend are the main pushes, that would mean that this move right here is the main push as it's going upwards. Again, this move right here would be a main push. This move right here would be a main push, and this move would be a main push because it's going with the trend and it looks like it has a lot of volatility. That means that the complex pullbacks are going to be the ones against the trend, a little bit smaller and not breaking the previous lows. So that means that this area would be your complex pullback. Again, this would be your complex pullback as you had a main push, retracement, main push, again, retracement, that's your complex pullback. And then we don't have another complex pullback. So we're starting to identify the complex pullbacks and the main pushes now. Same thing when we're bearish and we're going in a downtrend. Let me explain it. With the trend is your main pushes. As you can see, this is with the trend. Again, we have the retracement, then another main push, retracement, another main push, retracement, another main push, retracement, and another main push. So we've identified all our main pushes. So for our complex pullbacks now, we can identify anything that's going against the trend and looks like it's retracing and respecting the highs that were created. So right here, you can see you have that main push, you have the complex pullback, again, main push, complex pullback, main push, complex pullback, having that retracement for this zone to respect it, doesn't break this high, main push again, complex pullback, main push, complex pullback. So this is how you're going to identify whether you're inside a main push or a complex pullback. Now you might be asking, how can I use this to tell where am I in the market? And the first checklist that we're going to be doing is, what type of trend are you in? Are you within the leg of a main push or the leg within a complex pullback? And what is the next area that your leg is going to target? If you're in a complex pullback, you're going to be targeting a zone. If you're on a main push, you're going to be targeting the previous high or low. So in this case, if we're looking at this right now, we can see that we're clearly bullish as we keep breaking to the upside. But if we're here at the top, does that mean because we're bullish and we're sitting right here, does that mean we're going to continue buying? No. The reason why that is because I said you're first going to identify what trend you're in. Clearly, we're in an uptrend. Then we're going to be identifying, are we within the complex pullback or the main push? Right now, we're within the main push. And then we're going to be identifying our targets. Our target, if we're within the main push, would be the previous high that was created from the last main push and complex pullback, which in this case was this high right here. So that means our target's already been reached. So the next move that the market is most likely going to do is sell off to create a complex pullback. So if that means that we already reached a target within the main push, the next area that we're going to be looking for is the zone for the complex pullback to come into. So you mark out your demand zone in this case, and that will be your target, and you'll be looking for sells towards that zone. Then when that zone gets reached, that's when we can start looking for buys again, because that's within our overall trend. So that's why sometimes you can't really get lost with a higher time frame trend, and you need to actually understand where you're sitting within the market. You might be bullish overall, but you might be sitting within a bearish leg in that bullish trend. So let's do the same for this bearish momentum right here. So clearly we're having a bearish trend to the downside. We're having a push, complex pullback, push to the downside, break into the downside, respecting these highs right here, coming into a zone and then coming back to the downside. So clearly we're heading lower. So if we're sitting right here in price, where are we within this? First thing we've done is identify the trend. We're bearish. Second thing we need to do, what are we in? Are we in a complex pullback or a main push? In this case, we had the main push and we're clearly sitting within a complex pullback. So you might be thinking, okay, it's time to sell because we're within a downtrend. And in this case, you might actually be right, because remember what I said, identify the trend, identify which leg you're sitting in, complex pullback, main push, and then identify your targets. In this case, we've came into that last zone, we're respecting the high, so potentially we could be looking to sell off as we're in that zone where price might start reversing back to the downside and respecting that high. So in this case, the overall trend aligns with where we're sitting right now. So this is what you want to do. You want to really jump on the 4 hour, 1 hour, 15 minute and get your overall idea of where you're sitting. You can look on the 4 hour and the 1 hour main legs, see where you're sitting, and then you can jump on the lower time frame to really figure out if you're sitting within that complex pullback or main push. The one way I like to identify that, let's see we're sitting within this complex pullback right now. How do we know we're starting the new main push? I like to identify that by when the zone gets reached and price starts having two legs to the downside in this case, or in the direction that you're willing to trade. That's how I know now, okay, the main push has started, as these highs are now getting respected again on the lower time frame, like the 15 minute, are getting respected, and clearly we're breaking to the downside. So we can start looking for sells again and start looking to catch that main push. So this is how you're going to identify your bias for the day and where we're going to next. So now that you understand the bias, the next section that we're going to be jumping on is zones. Specifically, supply and demand zones. I'm going to be explaining to you how to identify them, how to use them. It's very easy. So let's jump right into it. The way I want you to remember this is demand. The D stands for down, and supply, the S stands for sky. So it means up, down and up. Demands are always going to be on the lows, and supply zones are always going to be on the highs. And our checklist for a valid supply or demand zone is if it came from a high or low, came from an inducement. This can be a way to actually validate a supply and demand zone. and causes a break of structure to the upside or the downside, depending if it is a demand or a supply zone. So in this case, you can see that we've created a low right here. We've came to the upside, leaving behind this low right here. The first things that we can look at, is it coming from a higher low? Yes, there was a low created right here. So clearly there is a low. Did it cause a break of structure? Yes, it did cause a break of structure to the downside. And did it come from an inducement? I like to use the inducement thing on the lower time frame. So I'll jump on like the 5, 10 minute, 15 minute and see if the actual bottom right here induced anything on the lower time frame, like any highs or lows before creating the push to the downside. Just gives me better confirmation that the market took its liquidity before making the big move to the upside. But in this case, this is a valid demand zone, as it had the main two things, which is it that came from a low and did it cause a break of structure to the upside. And then we mark our demand zone with the last candle of the low. Supply and demand zones, we're going to be finding them on the 4 hour, 1 hour, 15 minute, 1 minute. You can use them on any time frame, as the market is fractal. So that means every time frame will work the exact same way. Now, the same thing for the supply zones. Let's see if these supply zones are valid. So what price did is it pushed down, came back up, causing that retracement, did another push to the downside, leaving a high right here. Did this high cause the break of structure? Yes, it did. Did it come from an inducement? Maybe on the lower time frame it did. So that means that this is a valid supply zone. So we mark the supply zone out, and price normally likes to come right into it and respect it, then continue back to the downside. Again, for this one, price came up, left a high behind, caused the break of structure to the downside. So that means this is a valid supply zone right here. Price taps into it, respects it, and pushes back to the downside. So now that you know the idea of what a supply zone looks like, I'm going to show you how to actually find the best supply and demand zones in the market, because there is so many supply and demand zones all over the place. So I'm going to be teaching you what extreme and decisional zones are. Extreme zones are the origination point of that main push, and decisionals are the zone created right before the break of structure. So that can go for demand zones or supply zones. So in this case, as you can see, we created a low right here, broke to the upside, as you can see there, and it left behind two lows. You might be thinking, okay, if price wants to come down here, which low is it going to respect? And actually, it can respect both of them. The extreme is going to hold up the best, of course, because that's the origination point of this push to the upside. But then you've got the decisional, which is the zone right before the break of structure. So these are two zones I want you to mark out. If there's other zones like in between these two, like here, and then you have another push to the upside, I don't want you to mark this out. I only want you to mark the zone right before the break of structure, the last zone before price broke structure to the upside, and the first zone that created that push to the upside. So these are the two main zones that I want you to focus on. And same thing when it comes to the downside, and you have these supply zones. You have price coming down, creating a high, and then breaking to the downside. So price broke to the downside and left behind two zones. Okay, which area will hold? Actually, both can hold. So that means that this is the origination point, which is the extreme supply zone. So write this in your notes. The extreme zone is the origination point of the push, and the decisional zone is the zone right before the break of structure to the upside or the downside. So now that we understand what zones to use and what the zones look like, the next point that we're going to be talking about is inducements. And this is actually the most important part of the strategy, because the way you have to see it, the market moves from liquidity pool to liquidity pool. So the market always takes liquidity to have enough fuel to move in the other direction. So without an inducement, the market isn't really going to move. But inducements are quite easy to explain, so let me break this down real quick. So the first thing you want to know about the inducement timeframes that we're going to be using is the 4 hour, 1 hour, and the 15 minute. The one that I like to use the most is the 1 hour. So any high or low on the 1 hour is an inducement point. I like to call these inducement points from the 4 hour to around the 15 minute, the medium inducement. These are the ones that we want to actually use within our strategy that's actually going to reverse price to the opposite side, and we're going to be able to catch those sells or buys. So what I like to do, I like to jump on the 1 hour. Wherever I'm sitting, I like to just mark any relevant highs or lows that I see. Any highs that are popping up on the 1 hour, I like to mark them out so I have my inducement points right there. So if I'm looking to sell because I realized I'm within the complex pullback of a bearish trend, and the next point that I want to catch is that next main push to the downside, I'm going to be marking all the highs I see on the 1 hour and marking them out as a medium inducement. And we're going to be waiting for price to induce these points before continuing to the downside. But the one thing I don't want you to mark out as an inducement is the Asia session. This is actually very important. So in a second, you will see on my chart, it's a little box marked out, and the time for the Asia session in UK is 10 p.m. till 6 a.m. and in America is 5 p.m. till 1 a.m. You'll see it's marked with a blue box, and the high and low of that, we cannot use that as an inducement, as that tends to actually be a bit of a trap that the institutions try to trap retail traders into and then completely liquidate them out of the market. So now that we understand the main components of the strategy, let's jump into the chart and actually explain how to use it. We're going to be going through an example of a trade that I actually took myself, and we're going to be going through the different screenshots and explaining why I took this trade and how you can find these types of trades as well. The first thing I want to talk about is, like I said, the bias. We need to figure out where are we in the market, where's the market want to go to next, and what's our next target. So let's start with figuring out the bias. And clearly we're in a downtrend. You can see we're making a push to the downside, having a retracement, again causing a push, having a retracement, push to the downside again, retracement, push to the downside. Most of the time it is respecting the highs quite a bit, as you can see right here, and it is pushing to the downside. And this is on the 45 minutes. So between the 4 hour all the way to the 15-minute, you can use any of the time frames to kind of look for your bias. And in this case, we can identify that we are in a downtrend. So that means that this was our last push to the downside, as it did respect the high and it did break to the downside. And now we're having that complex pullback to the upside again. So that means that we're within an area that potentially could respect this zone, or it could come and induce this high to respect the previous zone up here before continuing back to the downside. But before we get too ahead of ourselves, let's figure out the next part, which is zones. The first thing I'm going to be talking about is zones. So what are some areas that we could see price respecting? The first zone that I can see is this most recent zone that was created from the main push. So you have this last candle right here. So we had a push to the downside, broke structure to the downside. You can see on the lower time frame, it did induce as well. So you had an inducement right here, induce to the upside, breaking to the downside, leaving a high, and potentially that could be respected. So that's the first zone that I'm seeing. The second zone that I'm also seeing is this zone that I marked out right here. And probably you can't see the last candle because it's probably in the lower time frame. But this is another zone that was created from a main push. So we had an inducement to the upside of an actually quite a decent high. We had inducement, break to the downside right here, and leaving a zone. And this is perfect when liquidity like this is left right before the zone. And this is why I had the main idea. We have these equal highs right here, which can be a great target for liquidity, and it could be an area where price could reverse from. Pairing with it being right before the zone, this could be an area that price could induce into and then reverse to the downside in the direction that we're overall going into. So now that we know which zone that we're looking for, now we can jump on the 1 hour to around the 30-minute or the 15-minute. That's what I kind of like to look between, and find our medium inducements. And the first thing that I'm seeing is these two medium inducements right here that you can see. You have this high right here, and then you have this high right here, which you can clearly see on the 45 minutes. So I would mark it out as a medium inducement. And this lines up perfect because this is a high that was right before our supply zone. So if price takes out this high, taps into it, we could start looking for some entries. Now we jump on the lower time frame. As you can see right here, we're on the 15-minute time frame, and we see if we're within our key time window. And as you can see right here, we're within this gray box. This is our Asia session. Like I said, that blue box from 10 p.m. till 6 a.m. In UK time, and I think American time 5 p.m. till 1 a.m. And then we have our London session, which is 8 a.m. till 9 a.m. UK time. And then American time, I think is 4 a.m. to 5 a.m. I might be wrong, but you had it up on the screen, so you make sure you have to note that down if you are in America. And we can see the inducement is happening right in our key time window, which is perfect. This is what we want to see. We want our inducement and price to tap within our zone, within our key time window. This is the main criteria because this is where the most volume is going to come into the market. So after seeing price induce into here in our key time window, then I jump even lower in time frame. I like to jump down from anywhere in the 1 minute to 3 minute time frame to then start looking for my entry criteria when I get an inducement in my key time window and I actually want to start looking to trade. And we jump on the 1 minute and we can see that the first inducement that happened was this right here within our key time window. So I wanted to start to look for a trade. First entry criteria that I could see is this last zone right here that was created before the inducement. I marked that out, and what I wanted it to do is for price to tap into it, give a slight reaction, and then not respect the zone. And what I wanted to see is on the 3 minute, an engulfing candle to the downside, closing bearish, and actually breaking this zone. As you can see now, we're on the 3 minute time frame, and you can use the 3 minute or the 5 minute time frame for this kind of engulfed candle entry. And in this case, you did get quite a decent candle to the downside, breaking that, but I think it was even better on the 5 minute. As you can see, you had big rejection to the upside, clearly closing bearish, breaking that zone, not respecting that 1 minute zone. So I manually executed my trade and I put my stop loss at the high. But before I go more into what happened next in this trade and what I did next, I want to go into the next section of the strategy, which is execution and risk management. So the first thing I want to talk about is our SL rules. And the first thing is that our stop loss must be between 2 to 10 pips. And you must be wondering, 2 to 10 pips, the stop loss is quite small. But that's how we catch these higher RR trades, and we're actually able to capitalize more on these trades rather than having a 20, 25, 30 pip stop loss, and we're only catching a 1 to 1, 1 to 2, where we can actually catch maybe a 1 to 10. And the second rule is that we try to cover the most recent low or high on the 1 minute time frame. After doing that, we also have to set our TPs. So what I do for my take profit system is that I do a minimum 1 to 3 RR, I close 50% of my trade. After that's hit, then the second TP is going to be my 10 RR trade. So 1 to 10 RR, then I close the rest of the trade. So it will be the other 50%. And I like to go break even after a 1 to 2 RR. This is fully backed up by data. This is just me doing loads and loads of back testing, looking what works best for me. This is me doing all my journaling on my live trades and then putting into ChatGPT and other AI softwares to then analyze it for me. And this is what it's told me, that my break even is the best point to go at a 1 to 2 RR, seeing all my other trades that's happened. So this is what I like to do. TP1, 1 to 3 RR, TP2, 1 to 10 RR, and we can go break even after 1 to 2 RR. And this actually gives me quite a decent win rate. This gives me a win rate around 50 to 60%. And if you don't want to use the 1 to 10 RR, you can just do 1 to 3 RR full volume. That also will work. So let me show you what that looks like. So if we have the 50 to 60% win rate, you might be thinking that's not 90, that's not 80, but it doesn't really matter. If you look at this right now, if you have a 50% win rate, you take 10 trades, that means that 5 of those trades should be losers and 5 should be winners. So if we see this right now and you have 5 losses, minus 1%, minus 1%, minus 1%, minus 1%, minus 1%, and then you have 5 winners right here, which is all 3%, because maybe you're closing your trade fully at 1 to 3 RR, you're still going to be up 10% after 10 trades. So you might be thinking, oh, like even with a 50% win rate after 10 trades, you're still up 10%, which is quite good. But then if you actually use what I use, which is the 1 to 3, 1 to 10 RR, you'll actually be able to capitalize a little bit more, and sometimes even way more if you're having a good trading period. So if you're still having that 50% win rate, that means 5 of your trades out of the 10 trades are going to be losers and 5 are going to be winners. That means that sometimes you're going to have 1.5% because you're taking half of the position off at 1 to 3 RR. But if you hit your full 1 to 10 RR TP, you're going to be making 6.5% from one single trade. So that means if you're losing 5 times and then maybe having 1.6.5, 1.6.5, and the rest are 1.5 trades, you're going to be up 12.5% after only 10 trades. But of course, it's not always going to look like 5 losers, 5 winners. Most likely, this is what's realistically going to look like. You're going to have 1 loss here, 1 break even here. You're going to have 1 win. It's going to be back and forth. And sometimes you can even have a really long winning period or a little bit longer losing period. But realistically, what's going to look like is like this. You're not going to have 5 losers in a row. You're not going to have 5 winners in a row. You can, but most likely it's going to be 1 win, 1 loss, 2 wins, 2 losses, 2 wins, 1 loss, 2 losses, break even. That's what it tends to be a lot of the time. And sometimes you may have 5, 6 winners in a row, because I've had that sometimes on a really good month. And I've also had a few losses back to back when I've had a little bit of a slow month. But I don't think I've had a losing streak over 3 trades in a very long time. So it's not something you have to worry too much about. But this is most likely what your journal is going to look like after taking these trades. But then you might be wondering, why do you trade with such a high RR? And the reason why I trade with such a high RR is that you can have 6 losers in a row, and it takes 1 to 10 RR TP to hit, and you're still up 0.5%, even though you had 6 losses in a row. It takes 1 single trade to bring you back into profit. So that means you might be on an account, you might be 6% in drawdown. It takes 1 single trade and you're back in profit. So this is what I like about my system, is that if I'm in heavy drawdown, 1 single trade can bring me out of that drawdown very easily. So now that you understand the risk management side of things, as you can see right here, I think my TP was about around 8 pips. So it's still between that 2 and 10 pip range. And I did go break even at 1 to 2, which was right here. And on this trade, I didn't go from a full 1 to 6. I closed fully at 1 to 3, which is completely fine. If that is your target area and you think price might reverse from this point, it's completely fine to close at 1 to 3, or just potentially just only do 1 to 3 trades. It's completely fine. A lot of my students still do this and they receive mobile payouts, multiple past accounts. So it's completely fine to do 1 to 3. Now we've practiced the strategy, we've got the strategy down. The second point of our cycle is going to be the prop firm route. The first thing I want to talk about in this section is selecting the correct prop firm. So the one thing I want you to look at is this list right here. I want you to go through this and make sure you check this before you select a prop firm. The first thing I want you to check is the drawdown type. Is it trailing stop loss? Is it set stop loss? There's so many different drawdown types, and the one thing that I try to stay away from is trailing stop loss. Then you have your daily loss rule. You want to see, maybe it might say 2% for your daily loss. That is very, very low. So you want to see something that's around 4 or 5% for your daily loss. The news rule, you want to see if they allow you to trade any sort of news. I think this is okay. You shouldn't really be trading during high impact news, but you want to be careful, as I see so many people failing their accounts because of news rules. Then you want to see the payout frequency. If it's saying like something every single month you get to withdraw a payout, that's pretty ridiculous. The minimum should be 2-week cycles. So every 2 weeks, you should be able to request a payout. Some firms like to do it every day payouts, maybe every week, every 5 days. So you just want to see what type of payout frequency they have. Then you want to see scaling plans. You want to see how much capital can you actually get with this firm. Because if you can only get 200-300K in capital, it's all right, but you might want to go with a firm that might let you get more and more capital, 700-800K, if they're a reliable firm. Then one thing I want you to stay away from is consistency rules. Prop firms that use this just want you to lose. I know a lot of the instant funded accounts have consistency rules, but I think that's quite fair because you're instantly funded, so they want you to be very consistent. But if you're trading a normal 2-phase account and they have a consistency rule, don't use that prop firm. Most likely they're trying to get you to fail the account, breach it in any way, just so they can get some money off you. The most recent prop firm I've been using is Breakthrough Capital so far. And for a prop firm that's not very well known, it's actually been very good. So they've got really good prices so far. Their spreads are very good. The news rule is decent. It's the 2-minute rule. I don't really trade during news anyway, so it's fine. Payout frequency is quite good, so you have it every 2 weeks. You can request a payout. They've got a decent scaling plan. I think I can go up to around 400K in capital, which is completely fine for me because I trade so many different firms. They don't have a consistency rule. And yeah, so everything is okay for me to trade with them. So I'm actually going to be requesting a payout. It should be today, so it's the 30th of December. It's 4 a.m. as you can see, and the payout should be requested today at 7 p.m. So I'll be making some TikToks and some videos about that. It is a small payout, but we'll go into that further when we get further down the list. But yeah, the most recent firm that I've used is Breakthrough Capital. So that's one of the firms that I've used. And this is the checklist that I kind of went through before I started trading with them. And so far they've been decent. I know both of the owners as well. Lovely people. So let's see if they do pay out. That's the main thing that we need to worry about. But I'm not too worried about that, as I've seen they actually do pay quite a lot of people and they have a decent support team behind them. Now, the one thing that you want to know, the passing strategy. What am I going to be using to pass this account? You've chosen an account. You're going to see how you can pass it. And this is one thing that I try to drill into all my students' heads. And it is, the longer you are on the evaluation stage, the longer you are not making money. So I try to tell them that the evaluation stages should be quite swift. You should be able to pass them quite quickly, as it's just a tool. You shouldn't be too scared to lose the evaluation, as if you haven't got enough money to kind of cycle through evaluations and kind of just pass them quickly, you shouldn't really be buying too many evaluations. You should be just saving up from your job, which is completely fine. But that's the main thing. Don't stick too long. I don't want you to be 3 months on the evaluation stage because you're not making money. So if you're taking 3 months to do the evaluation stage, how long is it going to take you to get a payout? So let's jump into the little list that I made. The first thing I want you to do is risk 1.5% to 2% per trade. So I want you to stick between this kind of zone. The reason why that is so you can pass these accounts within 1 or 2 trades and you're on to the next stage. The second point is try to have 2 to 3 evaluation accounts or even more so you can actually cycle through them. You can gain more capital. And if one is in deep drawdown, you're not sitting there for months trying to recover it. You're like, okay, you've moved past it. You're on to the next one and you're trying to pass it, which is completely normal. Number 3, try to aim to pass the account in 1 to 3 trades. Don't sit there and take 20 trades. Sometimes it might take you around 5, 6, 7 trades, depending on how the market conditions is, which is completely fine when you're already quite deep in the game. But in the beginning, you want to be trying to pass it with between 1 to 3 trades, maybe 4 trades, because if you're sitting there trading 20 trades just to pass phase one, maybe you're not ready yet. So the last thing I want to talk about is A+ setups when you're risking 2%. When you're risking this much, you better be finding the best setups, because I don't want you to go randomly into 2% drawdown because you took a stupid trade and you tried to make something up that wasn't even on the chart. So try to find the best trade types when you're risking a little bit more, because you're actually going to be losing a lot more if it's a horrible trade. So let's jump into an example on how I calculate how much I'm actually going to risk on a trade. So imagine we have a 100K account, and phase one is going to be 8%. That's your first target that you need to make the account. And then target two is going to be 5%. The first thing that I want to talk about is that if you want to do the 1 to 3 route and you only want to do 1 to 3s, not 1 to 10s, you want to fully close your trade at 1 to 3, I'm going to be explaining how to do that. So the first thing that I like to do is I like to take the first target, which is always 8%, and it's normally around 8K for a 100K account, and I like to half it. If I'm only doing a 1 to 3 TP, I like to half it. So I half it, and then I divide it by what my max RR would be, which would be $3,000 in this sense, because I'm doing a 1 to 3 on a 100K account. And when I divide that, I get a percentage that I'm going to risk. And what I do is I take 2 trades instead of 1. So I'm trying to pass this phase by just taking 2 1 to 3 trades. Phase 1 is passed by risking 1.3%, and boom, I'm in profits. I'm on to phase 2. If you're going to do the 1 to 10 route and your max RR is a 6.5%, because you're getting 1.5% from the 1 to 3 RR, and then you're getting the rest of that 5% from your 1 to 10 RR, you're going to be doing this. So you get your passing target, which is $8,000 in a sense. You have your winning RR, which is $6,500. And then you divide 8,000 by that, and it'll give you the percentage you want to risk. If this trade hits, the account is passed within one single trade, and you're on to the next phase. Let's say you go into a bit of drawdown. You're in 2% drawdown. What you want to do, when you're in drawdown, you just add how much you're in drawdown. In this case, I'm $2,000 in drawdown. I add that onto the target. In this case, it's going to be 10,000. And then do the same thing, divide it by my max RR. It'll give me the percentage. Risk this again, and you can pass the account by taking it out of drawdown and hitting your target with this amount of percentage. You can do the same if you're in profit. Let's say you're only 1K in profit. You add that onto the target and then divide it again. It'll give you the percentage. Now, phase 2, the part that everybody absolutely bottles. This is the section that most traders actually breach their accounts on. They pass that phase 1, they get too overexcited. They're like, yes, easy phase 2, and then boom, drawdown hits them and they're out. So I'm going to explain to you the strategy I use for phase 2, which is a little bit different than the phase 1. For phase 2, I like to aim for a 1 to 3 RR, and I like to risk whatever would take me to the target. So in this sense, it's going to be $5,000. I like to do 5,000 divided by 1.3 RR, which would be $3,000 because it's a 100K account. And it gave me 1.67, and don't make that joke, percent. So I like to risk this much with a 1 to 3 RR. I normally pass the phase 2 very quickly. So I like to stick between this kind of strategy when I'm trading at phase 2. Keeps it nice and simple, not overcomplicating it, just nice structure. Looking for that one trade type between those 2 pairs in my key time window. Boom, I get the A+ setup, and I've passed phase 2 like nothing. Then you've made it. You're a funded trader. But what I want you to do is, if you've never had any payouts, multiple payouts, you've passed multiple accounts, and this is your first account, don't take the certificate and post it online straight away. I'm a funded trader. I've made it. This doesn't mean anything yet, because you've still not extracted anything from the market. Thousands of people have gotten this certificate and have never got a payout. So if you start flexing online straight away, bro, I'm going to block you online. If I see this, none of you should be doing this. If you get a certificate straight away and you've not had multiple payouts, multiple accounts, don't start putting it online. Keep it to yourself. Keep composed. It's part of the strategy. Trust me, it will look much cooler when you post that payout certificate before you post that past account certificate. If you've already passed hundreds of these, you've passed and got multiple prop from payouts, this is okay. You can post up. You can say, okay, that's another one to the collection, whatever. But if this is your first one, do not flex. And this is another part that a lot of people tend to mess up in. A lot of people tend to blow their account before they actually get their first ever payout. So now I'm going to show you exactly how to get your first payout and then how to cycle the shit out of it so you can get thousands and thousands and thousands more payouts and then just get completely consistent. So let's start off first. This is you right now. I'm going to call you Bob, yeah? This is you. You've got your first 100K account. You're still working at KFC, which is completely fine. I would always recommend stay in a 9 to 5 while you're first starting to trade, as you're not really too worried about money. You're making money on the side, and then you're focusing on trading much more because you're not worried about your bills. You're not worried about spending on going out. You've got money in your pocket. It might not be a lot, but you can live off it. So it's okay to have a 9 to 5 job. But now you have your 100K, you're like, yeah, I'm going to make it as a full-time trader. First thing I want to tell you is one past account does not equal you quitting your job. Get that out of your head. One payout does not equal you quitting your job. And then 3 payouts also doesn't equal you quitting your job. So before I tell you what equals to the point where you should quit your job, I'm going to go into the whole section that I want you to understand. So now you've got a funded account. I want you to stick by these rules. The first thing is risk from 0.25% to around 1% maximum. I do not want to see anyone on a funded account risking above 1% until you're completely advanced. You've had hundreds of payouts and it's something that's just second nature to you. Until then, 0.25 till 1%. I risk around 1% and I've had multiple payouts and I still stick within that 1%. Number 2, no stupid setups. If the market doesn't make sense, close your computer. If you're looking at the chart and you're like, maybe this will work, maybe that will work, close your computer, bro. If you don't see something, okay, this is a high, this is a low, this is a zone, we're in a downtrend, if nothing is clicking like that, close your computer, you shouldn't be trading. Number 3, keep track of your payout date and time. Make notes and alerts. I see so many people losing out on some money quickly because, oh, I forgot it's my payout date. Oh, I didn't put an alarm for it. As soon as you get money in your account and you're like, okay, I've got money secured in my account. I hit a trade 1 to 3. I've got 3% in my account. Go on your broker, whoever it is, your prop firm account. Check when is my payout date. Mark it in your calendar. Mark it everywhere. Put alerts. Put ringtones. Put whatever you want to put. Just mark it so you know when your next payout date is. So when that date comes, boom, it's secured. You've requested your payout and it's gone. Because I see so many people do this. Even some of my students have done this. And it's just something that we tend to forget. So it's completely normal. But mark it out so you know when that payout will come. Then, number 4, triple check live account rules. A lot of people jump into live accounts thinking, I already know the rules. When a lot of the time, the rules change completely when you get to that live funded stage, because the evaluation stage, they have different rules, and then the live funded stage, they have also different rules. So go on your prop firm, go in the little question section, look through the funded live stage rules, and just triple check everything. Mark everything down, mark some things that might affect you down so you know. Right in the whiteboard, you have a whiteboard, you have a piece of paper, mark it down so you know if that will affect you. And this will actually save you a lot of the time from breaching your account over random stuff. I've seen so many people do this. I've seen my business partner do it. I've seen my students do it, breaching their account over like a 60-second SL rule, breaching their account over some news rules, breaching their account over max exposure rule. So there's so many different rules. You just need to keep it read off. If you don't understand anything, go on the support page, ask them, what does this mean? Break it down for me. That's what the support is there for. That's what they're getting paid for. So ask them. Any questions you have, straight away go to Discord, go to support for any prop firm and ask them. And the last point I want to talk about is that you shouldn't be trying to get large percentage payouts. I see a lot of people first get the funding account and they think, oh, I need to get 10%, I need to get 20%, 30%. Bro, you're just starting. It's okay to get 2, 3%, even 1%. Get your money back that you've invested into this and then kind of keep cycling it. Even my most recent payout right now that I'm about to withdraw with Breakthrough Capital is 1 single percent. And you might be thinking 1%, but I've gotten so used to it. The market gave me 1%. It's Christmas time. There's no trades available. So why not take the 1% instead of trying to gamble and make another 5%? That's 1K. I've got all my money back that I invested into all of their accounts. That's the way you have to see it. It's taking money out of the market, reinvesting it back in, taking money out of the market, reinvesting it back in. So for your first few payouts, don't try to go 5% plus. Just take 2, 3%. You have to try to fill that gap in your bank account before you try to try to look good online, like, oh, I've got 5% payout. That will come by time when you get a little bit more confident. I'm like, okay, I'm more confident with myself. I can trust myself more with these trades. I can aim for that 5-6% payout. And it took me quite a while, even when I first started becoming profitable. At the beginning, there's many times I went for larger payouts and I ended up with nothing for the day because I was like, yeah, I need to hit this 6% when I could have easily closed 4 or 5%. That's the way you need to see it. So aim for your 2 to 3% payouts. It's completely normal. So now you've had your first payout. Maybe you're getting a few more accounts, but you're still working that same little job that you absolutely hate. So now I'm going to show you exactly the point where I think is perfect for you to kind of move away from your 9 to 5 and focus on trading full time. You have reached at least $500K to $1 million in funding, which is very possible. One of my most recent students that even left me a review today, I didn't know he was going to write it, and it just made me so happy. I looked at it, and in 2 months, he managed to achieve over 400K in funding. So if he managed to achieve over 400K in funding, and I think it was about $7,000 extracted from the market, around that, $7,000 or $8,000 extracted from the market in 2 single months, just over 2 single months. What could you do in half a year, a year's time? This is very easily achievable. I've seen so many people do 500K, $1 million in funding, and I've seen so many people do 10,000 plus in payouts easily. When you reach this kind of area, that's when you become the cool guy. You can take the hat off. You're not going 9 to 5 anymore. You've got much more funded accounts. You're over that 500K point. You're chilling in payouts. You've got money put aside. You're chilling now. You can put your full focus onto trading. And now you have multiple accounts. And you might be wondering, okay, what can I do with these accounts? And the first thing that I want you to realize is that you shouldn't be copy trading straight away. There's a lot of people that think I have 6-7 accounts and I need to be copy trading all of them. I need to be putting them all in a copy trader, trade them all at once. That's the worst way to start your kind of payout journey, because what happens if you're having a really horrible month and you put every single account that you have into deep drawdown? What are you going to do then? You're not at your job anymore, so you've not got money coming in constantly. Maybe your savings are running out slowly. That's why I wouldn't recommend copy trading until you get completely confident in yourself. At the moment, I'm still cycling payouts. I've tried copy trading. It has worked very well for me. I'm quite comfortable with it. But for me at the moment, what has worked best is cycling my payouts, moving from account to account, securing a payout on one account, moving to the next one, securing a payout on one account, moving to the next one. So I'm going to show you a quick example of a video that I've made before, but I'm just going to break it down real quick. So imagine you have 5 accounts. You have 5 accounts and then you have 5 trading days. The way I want you to do is I want you to take one trade on one account and then move to the next account the next day. One trade on that account, move to the next account the next day. One trade on that account, move to the next account, and so on. So in this sense, imagine we have account 1 on Monday. Boom, I hit my 1 to 3. I'm up 3%. Tuesday, boom, I hit a loss, 1% down. Wednesday, move to the next account. Boom, I trade, I'm minus 1%, hit another loss. Thursday, I move on to my 4th account. Boom, I hit a win. I'm up 3% on the day. Friday, I move on to my last account. Boom, I hit another loss. I'm minus 1%. You might be thinking, okay, we just had quite a few losers in one single week, but it's completely fine. If you had this within one single account, you'd be up 3%. 3%, that's 6%. But then you have to minus 1, 2, 3. So you're only up 3% for the week. That's not too bad. But if you look at it like this, now because you cycled your accounts, you're up 3% on your first account, you're down 1% on the second account, you're down 1% on the third account, you're up 3% on your fourth account, and you're minus 1 on your fifth account. That puts you up 6% on the week. Just because you cycled your accounts now, you're up double of what you would have had if you traded this on only one account. So imagine if you have maybe 10 accounts, this would have went from 6% to 12%. So this is how you can easily, within 1-2 weeks, make 6-5% and continuously keep making that to get to that stage where you're making 10% plus every single month. This is why I always recommend to cycle accounts, because it's easy to get an account out of 1% drawdown. But let's say you had a really bad week and you had 5 losers. It's a little bit harder getting out of 5% drawdown. It's quite easy with my strategy, but if you're not perfecting it yet, it is quite difficult at the beginning. So this is why I would recommend always cycling the accounts, because now you're up 6%, you're chilling, you've got 6K in your account. Even if you want to blow these accounts, you can go buy another
how many ever accounts you want with that 6%. So that's the way you have to view it. So this was you during 2025. You were lost, you were strategy hopping, you were in deep drawdown, about to give up, still at that 95 you hate. You had that gambling mindset of just, oh, I need to pass this account, full port it, boom. And you were looking absolutely stressed every single day, looking at your laptop like this. And this is now going to be you in 2026 after implementing everything that I told you. Easy, you're going to be profitable. 1 million plus in funded, nonchalant. This will even add height onto you, 6 foot plus. And don't quote me on this. But this is kind of what the goal is. You want to get to that profitability stage. You want to have enough funding, and you get to the area where you're not really stressed about trading anymore. It's just a second nature to you. You've got the skill down, and this is how you're going to get to it. And everything that I just gave you right now was not random. Because if you can see this right here, it was a brief overview of the exact roadmap that I planned for my own students. And this is the roadmap that's gotten so many of my students profitable. And this is the student that I was talking about today. This is the student that over 2 months ago, he joined MV Academy, and I put him through a similar guide and roadmap to go through to become profitable. And just in over 2 months, he managed to secure over 400K in funding and have $9,700. That's even more than I said earlier because I couldn't remember because how crazy it was. So he had over $9,700 in payouts. And what made me absolutely happy is that he managed to change his life, and he took his parents and his brother to Switzerland for Christmas. Imagine being able to do that in 2 single months. 2 months ago, you were just sitting there lost, whatever, and he just finished the year off with an absolute bang. I can't even imagine how proud his parents must be of this. And honestly, stuff like this is very much possible if you put the right amount of work in. And there's so many examples that I've had of people actually using this and becoming profitable and changing their trading mindset completely over. If this helped you, please leave a like so other traders who are struggling with the exact same thing will see this video. And if you're really serious about making a change in your trading in 2026, subscribe to the channel because I leave so many trade reviews, trade breakdowns, and free sauce that I give to people that I wish I could have got when I was first starting. 2026 is much closer than you think. It's just a few hours away. And next year, I don't want to see the same traders in my comment section having the same conversations. I want to see payout screenshots posted everywhere. So again, make sure you're not having the same conversation with yourself next year.